Welcome to Covered, the insurance law podcast for corporate policyholders. We've been on a bit of a hiatus, too much work going on and too many things to do, but we're back and we plan to stay back. So for those of our loyal listeners who have been so anxiously awaiting a new episode, here you go. So with me today is Suzanne Day, and one of our sterling colleagues here at Bracewell's insurance recovery practice. And Suzanne, we spent a lot of time talking about what kind of content we can deliver that our listeners would find interesting, right? Because, it's a pretty sophisticated crowd. These guys know a lot about insurance. And so we're trying to figure out what can we say that would be helpful. And so we kind of spend a lot of time thinking about that. And I think that we may have landed on one. So today we're going to talk about something that seems both basic and complicated at the same time. This is insurance requirements and contracts. How does that sound like a topic to you?
Well, I think this is a really interesting topic, Vince, which may amuse some of our listeners, because I think these are the parts of contracts that a lot of people see and then their eyes glaze over and they look for some numbers for limits and then they move on to the next possibly more intriguing part of the contract. But, in our line of work, we see that these kinds of requirements, these clauses in contracts really can cause a lot of mischief. And so actually really require a lot of specific attention on them. So this is something that I think our listeners really ought to hear and listen up for.
I agree. In fact, I like this topic so much. Why don't we make it a two-part topic? And so we'll cover a little bit today, and then we'll come back on another episode and kind of finish off some general thoughts here. And so we see these all the time, right? And we see them in various forms, and some of them have very simple requirements, a couple of paragraphs, like you'll get whatever insurance is reasonable and customary for the scope of the services in this contract. And some of them are pages and pages and pages of detailed specifics. And some of our clients like the more general ones, and some of our clients like the more detailed ones. And so we see these come across. It's not just our clients, it's that our clients will get them from their counterparties. And so we see a wide variety of these things. I think this is a great topic. And one of the things that whenever we're asked to review one of these, maybe we're negotiating a contract and they say, hey, could you guys look at the insurance provisions? Or maybe some incident has happened and we're now on the back end and it's, hey, there are some insurance procurement requirements in this contract. Let's start and look at those. Whatever it is that we're doing, we tend to kind of take a quick glance at it before we dig in. And one of the things that I always look at is I read the wording for there's usually a bunch of coverages, but one of the foundational ones is commercial general liability coverage. And so I read the wording there, and it's less common these days, but at least 20 to 30% of the time, we still see comprehensive general liability, which hasn't been sold in the United States since 1986. And so this document, these requirements are living proof of the pros and cons of desktop publishing and Microsoft Word and cut and paste and save as. And so, you have somebody who spent a lot of time working on a form many years ago, and the company might say, well, yeah, this is our wording. And they just don't ever update it to keep abreast of changes in the insurance marketplace. And so, one of the things that's kind of a key thing to look at is just how much recent effort has gone into this. You can sort of tell from that right there. That's one of the markers. That's my thought. Do you have a thought about that?
Well, I think that's just a really good reminder to lawyers everywhere that you have to refresh your forms. This morning, you and I were talking about how hard it is sometimes when you're managing a team of lawyers, like I used to do. It was really hard in the first instance to get them to use the form. I had to get my team in order to use the form, and then you spend a lot of time trying as hard as you can, deploying all sorts of different negotiation tactics to get the counterparty to use your form, and then so that takes a lot of time and a lot of energy. And then the third step is you got to refresh the form. It often feels like people stop after the first two because those take so much work, is to get your form right, to get the other counterparty's condition that they're going to use your form, that you don't want to amend it. You don't want to go back and refresh it because then it feels like you got to start pushing that boulder back up the hill again. But it is really important, at least annually, to look at the requirements of your forms or in your form contracts to make sure that they still make sense, both for the market, as you're mentioning, but also for your business, for what you're trying to accomplish with these contracts. Oftentimes, your client's business may change dramatically in a year, and it's going to require a different kind of risk tolerance or a different kind of coverage that you might want your counterparties to buy or that you're going to be buying. And so it really is something that you have to do regularly.
Well, I like that. That's right. I mean, so if you buy, one of the things that we'll talk about a little bit more, but if you buy a new division, right, that you acquire, and maybe it has a professional services arm to it, and that's a risk that maybe you didn't have before, right? If you were just a pure manufacturer, for example, and now you're in the engineering business, and so that's a new, you have to update it for that. One of the other things that I think that we do spend some time on, and when we talk to clients about this, they're like, well, I've got two different sort of things that I'm trying to accomplish here. Do I need one form or two? And sometimes, and we've had clients that have had 3 or 4 versions of this thing, right? You don't want to have an infinite number of templates, because at that point it becomes just as bad as having just one, right? But what we do, I think that 2, and there's I'm sure some kind of logarithmic calculation here, but 2 to 3 or maybe 4 is kind of the outside limit of what I would think is a manageable, from a contracting standpoint, a manageable number of templates. But one of the things we help clients with is doing this with a risk-based approach, right? So if you have somebody who is dealing with things that are heated to 1200 degrees and under enormous amounts of pressure, that contract has a bunch of risk on it. And so that might require a very different approach as to someone who comes out and maintains your landscaping, right? And in front of a facility, right? Which seems like relatively lower risk. It's not to say zero, but it's certainly less. And so we have worked with clients, and I think had some success with coming up with, like, if the contract has a value of more than X, or if it involves a certain line of more hazardous activity, then they change the agreements. One of the other things that we have seen a client do recently is they were on the very detailed sort of set of end of the spectrum there, but some of the contract requirements that they had didn't seem to apply to the contract we were dealing with, and so we ended up inserting a clause that said, you, other counterparty, will get the following insurance coverages unless we specifically agree that you don't have to get them. And that was a way for them to have this process of, oh yeah, we agree you don't need marine cargo or whatever if there's not going to be anything on the water or on a ship or in a box. And so I think that's a useful way to deal with some of these things. Again, you want to have a template that works, but that gets you what you need, but is also functional. And that's the tricky thing here, because if it becomes so burdensome and complex, then the first thing that's going to happen is people are going to stop using it.
Yeah. Well, and this is not a podcast about contract management software, but there are plenty of vendors out there who have products that are designed to try and help lawyers work through that, so that you can have set up, for example, you can work on the basis that your template should change for the specific business that you're drafting for, the kind of business, the kind of risk. Sometimes you can look at the frequency that the counterparty is going to be on your premises. For example, if you're trying to put together a contract that is going to protect you against harm that your contractors might cause when they're on your premises, you can match the kind of form you use to the number of visits anticipated per year, or the kind of activities, or the dollar value, that kind of thing, and have a form set up that it makes the contract drafting a lot easier. You can check certain boxes, and then it'll spit out the contract for you. So it prevents, or it eliminates, the use of 4 forms, cutting and pasting. It's just one document, and if you check the right boxes, the program puts it together, for example. But those kind of programs work pretty well, actually. I think with insurance requirements, those are one of the kinds of contract sections that contract management software actually can. If you put a lot of thought in the setup of the template, those can be very, very helpful.
Yeah, no, that's great. One of the other things that we've seen clients struggle with is kind of on this piece of it is certificates of insurance, right? And so a lot of these things say you have to give a certificate of insurance. It has to prove this, that you have these coverages and this kind of stuff. And you have to, it has to say that you can't cancel it within 30 days notice to us, or any material reduction in coverage and things like that. And the thing that's important to remember is the certificates of insurance are really handy. I mean, they're very good on a business level of communicating key information in a form that people are used to seeing it. They're great for that. But courts have said you got to be careful about relying on them, because they all have that sentence that says this doesn't change the actual terms and conditions of the policy. And you have to look at that to, figure out exactly what's covered. And the reason is because, of course, in a one-page certificate, it's not going to summarize all of the important parts of a policy, right? I mean, there's more to it than that. Now, there are exceptions to this rule. There are courts that have found that certificates of insurance create expectations that are enforceable and create rights in that way, and you can rely on them in some cases, but it's something you got to be careful about. And so some clients, they know this, and so they say, well, I want the actual insurance policies. That's the only way I can be safe. And the truth is, you can't even really be safe then because there's no guarantee they don't change them after you get them, right? But some clients have asked for that, and we've heard their counterparties push back on, well, we view our insurance program as proprietary. We don't want to share it with you, and so we struggle with that. And we say, okay, well, if we hear that, then maybe we say, tell you what, if there's a claim, then you'll give us this information. You'll cooperate with us in the claim process. Do you have a thought about the best way to approach that?
Well, I think that does come down to doing sort of a risk-adjusted analysis for your most important contracts, where the counterparty is going to be, you're going to be paying the counterparty quite a lot of money. The counterparty is going to be on your premises really frequently, or some relationship that you think is significant. And that's really something that each client has to define themselves. For those contracts, I would require, or I would recommend, at least being able to review, if not the entire policy, which is the first ask, the deck sheets for the policies, so that you as the person receiving the benefits of the other party's required insurance can see for yourself the limits. You can see, particularly when you have excess towers. So you talked earlier about commercial general liability. Often that's a primary policy, which maybe a $2 million limit, a $5 million limit. But then if you're requiring excess up to the $100 million or something, you would want to make sure that the excess has the primary correctly listed. Things like this are, as I said, there's a lot of mischief that can be caused. Unfortunately, there are a lot of people's hands that touch policies when they get put together. And sometimes folks are cutting and pasting and are not paying as good of attention as you would when it's a situation when it's your biggest customer or your biggest vendor. And so you want to make sure and see for yourself, have someone on your team see for themselves that in fact, yes, the tower does stack up with all the right policies underlying it. You want to be able to see if you can't see the endorsements, you can see the list of endorsements, and those are often standard policy forms. So you kind of know what you're getting. So that can be, to me, a good middle ground if your counterparty is both important and also has the leverage to tell you absolutely not, you're not going to see the policy. If you can negotiate yourself down to the deck pages of the policies, that can give you some sense of comfort that would be missing just from a certificate of insurance.
Yeah, I think that's good advice. I remember I had a case many years ago that the insurance procurement provision said that our client would provide this other company insurance in the amount and type that the other company found satisfactory. That's it. Literally, that's what it said. And in this particular year, they had a loss that was north of $500 million. I mean, it was like $600 million in alleged liabilities, and our client had a pretty healthy tower of insurance, and the counterparty said, "Well, yeah, we want that. We want it all, and that's what's satisfactory to us." And we're like, "What are you talking about?" Here's a certificate we gave you that said that we had $1 million policy, and they said, "Yeah, we get all that, but we want the rest of it too." And we said, "Well, wait a minute." So I was trying to figure out how to do this, right? Because you had sort of a fairly vague, open-ended, requirement, and there was a lot of money at stake. And so I'm sitting there and I'm thinking, how can we approach this? And it occurred to me that if they gave them a certificate for $1 million policy in this year, maybe they'd given them certificates in past years. And they said, "Oh yeah, we have." Every year for, a decade, we've given them a certificate that says it's $1 million limit. And I said, "Okay, well, can you send me those?" They said, "Sure, yeah." So they sent me a stack of them. Now I've got a decade worth of, here's $1 million. And I said, did the other company ever complain to you? Did they ever say that's not enough? That's not satisfactory? They said, no, they never said boo. And so at that point, now we started to have sort of a course of performance argument, right? And one of the things that courts look at in trying to figure out what parties meant to a contract, what they intended, is they look at what the parties actually did after they signed that contract, right? How they have performed during the course of that contract. And I thought that was pretty compelling evidence. But if one of the things that you want to do in response to an incident, and you start digging these things out and dusting them off, and you look at them, and if the first reaction you have is, "Hey, let's get a time machine," that's not great, right? And so I think one of the things that we really work hard with clients on is ask them, say, "Look, tell you what, why don't you come up with 3 things that you're really trying to accomplish here, or 5 scenarios that you've had bad experiences with in the past, and let's look at how they would play out under this wording. And you do this for indemnity too, right? And nobody has perfect hindsight is 2020, foresight is not. But I think that's the best way you can go about trying to manage these things, and hopefully that that helps get clients. It may or may not be perfect going forward, but at least I think they've thought through it in a disciplined way, and that's step one.
Along those lines, Vince, what do you think about requiring a specific form of either, usually it's an endorsement. As we've mentioned, there are standard forms that sometimes if you see the deck page, you can see the numbers from the ISO form. And so then you have some confidence about what is in the endorsement, even if you can't see it. I have seen some insurance requirements where the one party requires the other party to have, for example, an ongoing operations additional insured endorsement under form ISO blah, 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 or no less favorable to the party, something like that, to actually refer to a specific form. What do you think about that?
Yeah, I see those too. And like some people really like the CG 2010 wording on additional insured provisions. And again, there are pros and cons to this, right? If the more specific you make your requirements, the more clarity you have. But sometimes your counterparties would be like, look, I can't deal with this, right? We buy our insurance across our whole business, and we're certainly receptive to what your needs are, but we use a different form, and here's the wording. And if you want to change something, let's talk about it. But we can't go and rebuy our entire tower, to deal with this. And so I think you do see practical issues coming back and forth. The businesses that want to do business with each other want to be accommodating to each other's needs, but it presents other challenges based on and that assumes that people want to be cooperative. Yet it's not always the case, right? Sometimes the level of cooperation has limits. And so I think if you feel strongly about it, then having that and having a reason why, and sometimes it's just, we had a really bad experience. Let me tell you what happened. And so now this is what we require. And if people hear that, they might say, okay, I get it. Yeah, that's fine. But so I think that's something to think about. And one of the things that when you start looking at additional insured requirements in contracts, a lot of it centers on what risks we're trying to manage, right? Is our vehicles going to be involved, right? Because every CGL policy has, most CGL policies have an auto exclusion. And so maybe you need commercial auto policy if there's going to be, that risk that's at play here. Do you need workers' comp? Do you need pollution? Do you need specialty coverages by industry? And one of the things I think that you look at is who's in the best position to prevent the loss, who's in the best position to obtain the coverage at the best price with the best terms, and then try and think through it there. I mean, I think as you look at these things, these are all kind of wrapped up into one big pot, but you just got to go through it step by step and approach it in a disciplined way. Well, Suzanne, I think that's enough for today, but I really have enjoyed this topic. I think it's a lot of fun to talk through these things, and because we see them every day. How about we do make this episode 2? So we'll come back. Our next episode will be a continuation of this discussion, and we'll kind of pick up with these themes. But that's it for today. So thank you, Suzanne, for joining me, and our listeners. Thank you for being patient with us, and welcome back. And we'll have episode 2, more on insurance procurement requirements, coming to you soon. Thanks.